Welcome all attendees to this event organized by PKF Mexico and KBKG. We will speak today about a very, very important issue, which is about the warnings to 150 companies about transfer pricing practices issued by the IRS. The microphones will be turned off during the conference, but they will be open for a session of questions and answers at the end. Transfer pricing is one of the most important topics for multinationals companies at this time. Compliance, documentation requirements, disclosures, and controversy matters have increased over the years. For PKF and for KBKG, it is very important to provide solutions to our clients in audit, accounting, business solutions, tax, corporate finance, and of course, transfer pricing. I really want to thank our speaker today, Alex Martin, who is a principal and transfer pricing partner at the practice at KBKG. A big thank to all of you who joined us for this webinar. IRS issues warnings to 150 companies about transfer pricing practices. Your participation and engagement are truly appreciated. So, Alex, thank you very much for being here with us. And let's move to the first point of this interesting webinar. So please, let's go to the first question we have for you, Alex. And it's
Hola, Jimmy. It's wonderful to be with you again, my friend.
Okay, thank you, my friend Alex. So can we please talk a little bit about the general overview of transfer pricing regulations in the U.S.?
Sure. Transfer pricing regulations, transfer pricing rules have been in place in the United States for a very long time. However, there are many similarities with companies with many other countries. Transfer pricing rules are based on the arm's length standard. You should be charging the same price for inventory, services, royalties, loans, any cross-border transactions on an arm's length basis. In other words, you should charge the same price as if you were unrelated companies. Now, there are some interesting segments of the U.S. transfer pricing rules that may be a little different, but in our experience, the IRS transfer pricing regulations are quite practical. They are more concerned about transfer pricing profit results as a starting point, as opposed to perhaps transfer pricing policies. They also have certain disclosure forms in the U.S. tax return, which explain who is the company on the other side of the transaction, and also the volume or amount of transaction by type of transaction. So in essence, while the U.S. had many of the first transfer pricing rules, a lot of the principles, the thought process, the audit approach are actually quite similar to Mexico and many other countries.
Yes, and what happens if the IRS disagrees with transfer pricing, Alex?
Sure. The transfer pricing is audited as part of, is usually audited as part of a normal regular tax audit. They will request transfer pricing documentation. We'll talk about that in a minute. But And but they do ask very detailed questions about how do companies set up transfer pricing, and more importantly, why are the results of the transfer prices arm's length? So these rules, these regulations are straightforward from a practical perspective, but the audits can be very detailed because transfer pricing is a very fact important audit issue.
Actually, I think we have an example that we can see in the next slide.
Sure. And I think, Jimmy, you and I spend a lot of time on determining or understanding how companies operate on a cross-border basis. So one very typical approach is a distribution company where let's say a subsidiary might purchase products for resale in this case, the US market. Also, limited risk manufacturers, where companies that manufacture goods, perhaps a subsidiary is relying on technology and perhaps components or parts from related companies. So, Jimmy, maybe you could also provide some insight from your perspective too.
Yes, yes, definitely, my friend. Yeah. In our experience, Alex, typical limited risk manufacturers or limited risk distributors are one of the most common functions and the activities performed by entities in many countries. In this case, including, of course, the US entities that are subsidiaries of big multinational companies. And so they are determined or they obtain a very low profit consistent with the low risk and low functions they have. The problem, or one of the typical problems, is when the companies they are obtaining even lower profits or losses. So when they have losses, that may be difficult to explain for the tax authorities why a limited risk distributor or a limited risk manufacturers may have some losses if they are basically performing low profile, low risk functions. Do you agree with that?
Absolutely. And the thought process from a theory point of view is that if you were an independent distributor, for example, and buying products from a manufacturing company, you would not continue selling those products if you were always incurring a loss. In other words, you would negotiate a different price to earn a certain level of profit. And that is the basic thought process when it comes to an IRS tax audit. You would not continue to be in business if you were always losing money year after year.
Exactly. Yes, and it seems we have a brief example in the next slide.
Yeah, and I just thought I would provide some context on what happens if the IRS does make a transfer pricing adjustment. Well, if let's say we have a larger company and the IRS makes a $10 million US $10 million transfer pricing adjustment. Well, you would owe additional tax at a 21% federal rate, and they can apply penalties of 20%, non-deductible penalties, if there is no transfer pricing documentation in place. So in addition to that, since many of the US states also have income tax, corporate income tax, you would also owe additional US state taxes. And just because the IRS has made a transfer pricing adjustment, that does not mean the other country on the other side of the border will agree with that adjustment. So basically, there could be a double tax issue. So from a practical perspective, this is a very expensive tax issue because you're not arguing over research and development or meals and entertainment expenses. It's just an IRS agent. You have been overcharged by your parent company, and therefore we are making a tax adjustment. So those penalties can actually go up to 40% once the transfer pricing adjustment is increased to $20 million.
Which may be a big impact for multinational companies, especially medium-sized companies and small multinational companies, right?
And it is understandable that a medium-sized company, for example, has not reviewed transfer pricing before. Well, why? Well, it's a new topic for them, and perhaps they consider a loss or very small profits to be due to poor market conditions or poor just poor business decisions or COVID or other things like that. And so having an IRS agent ask about transfer pricing can be a big surprise, especially if the taxes payable is not a key part of running the business.
Well, great. So Alex, could you please elaborate, moving forward on the topic, on the Inflation Reduction Act and its impact on TP regulations in both the US and abroad, please?
Sure. The Inflation Reduction Act had a very large different rules and regulations that came in for all sorts of parts of the business world, like batteries, green energy, things like that. But probably the most important thing from a transfer pricing perspective is that the IRS received $40 billion in additional revenue for running the Internal Revenue Service. For the I would say, last 20 years, if not longer, the IRS has not received a full budget for hiring people. And the people who have been working at the IRS are retiring at a very quick rate. So basically, this gave the IRS some ability to invest in auditing systems and improving customer relationships. But also from a transfer pricing perspective, the IRS has hired a lot of economists, and that's why we're seeing more activity in the transfer pricing audit space.
And what prompts the IRS to conduct reviews of profits obtained by distributors in the US?
Well, building off of the Inflation Reduction Act, to train economists to be transfer pricing experts or specialists, really auditing distribution companies is probably the best way for auditors to understand how companies operate and the most straightforward way to raise revenue, especially with inexperienced auditors. And the reason being is that from an IRS and many other tax authority perspective, their thought process is distribution companies should not incur losses. Any kind of poor business conditions or foreign exchange issues, or really any kind of business issue that may come up that impacts profitability, their argument is that the parent company is better positioned to bear the risk and pay for any poor conditions, and therefore the distributors should be earning reasonable, quote unquote, reasonable profits. That will depend on the industry. So it's it's the most straightforward way to audit companies. And also, since many companies have not been audited in a very long time, um, this type of compliance campaign is a big surprise for many companies, including some of our new clients have contacted us to assist in answering the questions.
Yes, I'm talking generally about the methodology, transfer pricing method for distributors and for limited risk distributors. As you may probably agree with me, they normally use the resale price method, or we normally use as experts the resale price method. But the problem with the resale price method typically is that sometimes it doesn't consider the expenses incurred in the operation, in this case in the US, right? So that's why sometimes they have to use the TNMM or the transactional net margin method or an operating profit margin to be tested with comparable entities. Or we also have the option to use the modified resale price method, right, as established by the OECD. So in your experience, Alex, what are the challenges of the distributors in the application of the transfer pricing methodology in the US?
The IRS generally references the comparable profits method, and if outside of the US, it is called the transactional net margin method or TNMM. In practice, it's very much the same, but from an IRS perspective, they may not understand much about the business, but just looking at operating profit as a percentage of net sales, for example, that is a easy way for them to determine if the company is earning a reasonable level of profit or not after the transfer prices. So while a resale price method, or you may be familiar with the resale price method or transactional net margin method, realistically, the IRS is starting with operating profit as a percentage of net sales, and they would be comparing the US subsidiary with other similar distribution companies. The other thing that's valuable there is that the IRS can apply the same approach, the same benchmarking companies across many different distribution companies as part of mini audit. So it may sound like a simplified approach, but it is a popular and productive approach for tax authorities.
Great, Alex. So let's talk briefly about the red flags. What are the most common red flags that taxpayers must consider to ensure compliance with TP regulations in the US?
I'm a very big fan of being practical in this area. So if you are trying to understand how an IRS auditor or Mexican auditor or any country, UK, China, what have you, I suggest starting at operating profit for each of your subsidiaries. So operating profit as a percentage of net sales. That approach is what the IRS auditor will look at. So if you have tax losses at the operating margin level, that is a red flag. The second thing that's also a red flag is tax net operating losses. If your company in the US has large tax net operating losses, it may not make sense. That is also a red flag from an IRS perspective, because you have been incurring losses for multiple years. So in essence, you can expect that the IRS starting point would be 3% of net sales or 5% or something above break even, and certainly not losses. So if you're looking at the company results by country, that will give you the best insight for figuring out where there's a problem or perhaps actually an opportunity.
I think we have an example, right? Real example. So moving forward to yes.
Sure. One thing that we have been helping clients work with is to help them utilize tax losses, which, because due to COVID or changes in supply chains, we find that many companies have big profits in one country and big losses in another. So where does that leave you? Well, let's say we have a Mexican parent company with a US reseller or distributor. And due to a market downturn, their revenues went from 70 million down to 65 million. Well, what can you do here? Well, this created a loss of $2.5 million. Well, how did an IRS agent look at this? Well, they would argue as a starting point that there should be a transfer pricing adjustment of, let's say, $5 million because a distributor should not incur losses. And I highlighted it, operating profit, but also earnings before interest and tax is another equivalent of operating profit. So what could you do here? Well, if we can jump to the next slide here. And I'm sorry, let me highlight also, let's also say that the Mexican parent company has $6 million in profit and is paying $1.8 million in tax. All right, so just now to the next slide. Well, from an audit risk perspective, they would expect that the distributor would earn profits. And while foreign exchange may be an issue, their starting point is always the parent company is better positioned to manage risk. Well, what would happen if the Mexican parent company reduced transfer pricing, in this case, by $2.5 million? Well, that would certainly lower the risk because the IRS really have problems over losses, and break even is not a great answer, but it is better than incurring a loss. Well, by reducing the tax loss, and if you lower transfer pricing to reduce the amount of profit in Mexico, actually you'd realize some tax savings just from that. So basically a two for one, you would reduce your tax audit risk, and two, you would also reduce the amount of tax paid in Mexico. And this works also from a Mexican perspective in that we could argue that the US company was incurring losses, so the parent company was probably earning too much profit.
Great, Alex. We are aware of the IRS sending notices to between 150 and 180 taxpayers. That may affect many multinationals operating in the US. Do you think it is a situation that may be extended to more companies?
It certainly can be expanded to more companies. I was actually most surprised that a company with only $25 million US in revenue was actually selected for this program. And I've been doing transfer pricing for, well, you too, 25 years. I have not seen the IRS go after companies with that only $25 million in revenue in a very long time. So this says they're trying to get all sorts of companies that are distributors of all sizes and target who are the companies that have a problem. And while this was not an audit, they sent out letters to these companies and said, we want a detailed explanation as to why your company is complying with US transfer pricing rules. And so even though this company was only $25 million in revenue, and their losses were largely due to COVID, the IRS wanted a full explanation and also an explanation of why the company was incurring losses. So straightforward approach, a very smart approach from an IRS perspective. But if you're having losses, we want to know why. If you do not provide an answer, they would move to an audit.
And that is a course of action for taxpayers moving forward, right?
And I think that here's the most practical approach. Take a look at the operating profit for your US subsidiaries for the last couple years or for open tax years. That will give you a handle on if the company has a problem or not. Certainly, that you can expect a risk if the US company is incurring losses and generating tax net operating losses. That would be the starting point for me. And it's actually the most straightforward approach from an IRS perspective. So you are anticipating what the IRS does.
Great. Thank you very much, Alex Martin, Principal and Transfer Pricing Practice Leader at KBKG, for this interesting conversation. I really want to thank all of you who joined this webinar. IRS issues warnings to 150 companies about transfer pricing practices. Your participation and engagement were truly appreciated. It is fantastic to have attendees from different countries come together to discuss such an important topic. I hope you found the discussion insightful and you gained some valuable takeaways to apply within your organization. Thanks again for being part of this webinar, and we look forward to connecting with you again soon at our future PKF events. Thank you, Alex.
Thank you. Take care. Thank you, Jimmy. Thank you to everyone.
Thank you very much.
All right. Bye.
Bye.